Okay, let's dive into it. We're talking about one of the, well, most intense rituals in business life, right? That thing that happens 12 times a year, every single year, the month-end close.
Oh, it absolutely is a real pressure cooker. And, while finance definitely does the heavy lifting, the pressure, it ripples out everywhere.
Yeah, you've got IT, making sure data feeds work, operations providing key cutoffs.
Exactly. IT scrambling, ops, delivering critical accruals. It's that specific period where finance really goes deep. Data prep, validation, calculation, the works.
And the mission, I mean, it sounds simple, but actually doing it is, well, it's huge. You need financial statements that are spot on, accurate, complete, and on time.
Monumentally demanding is the right phrase because management, auditors, regulators, they all rely on these numbers for big decisions. Trust is everything here.
Absolutely. So, okay, for this deep dive, what's our mission for you, the listener?
Well, we want to extract that key strategic knowledge, show you the best practices, what separates those really high-performing teams, the fast, accurate ones, from the ones that seem uh, slower, maybe a bit more chaotic.
Right. Let's start with time. Everyone talks about a fast close. What does that even mean today? What are the benchmarks people aim for?
Good question. Look, the big aspiration, especially for large global companies, often it's the 3-day close.
3 days. Wow.
Yeah, aiming to get the books essentially shut and core numbers out by the end of business day 3 of the new month. Now, more common, especially if you're well automated, is probably the 5-day close.
But hold on. For most businesses, maybe smaller or mid-sized ones, isn't chasing 3 days maybe a bit unrealistic? A vanity metric even.
That's a really important point.
Many teams are realistically looking at a 10, maybe even 14-day close. How do you square that?
You have to square it carefully. The absolute first rule has to be speed comes second to quality.
Yes.
Always. If you hit day 3 but your numbers are riddled with errors, you've failed, point blank. The process must be accurate, it has to be controlled, and it needs to be repeatable. You just cannot sacrifice substance for speed.
That makes sense. And that focus on quality, it ties into how rigorous accountants are internally, right? Our sources mentioned this checklist they use for key balances, CEABOP.
CEOP, yes. It sounds technical, but it's basically the gold standard checklist for accountants, the ultimate test for financial health.
Okay, break that down for us. CEAVOP.
Right. It stands for completeness, existence, accuracy, valuation, ownership, and presentation.
Okay.
So for every significant account, accountants are checking. Are all the transactions actually in there? Completeness? Does this asset we've recorded actually exist? Is the dollar amount correct? Accuracy? Is it valued properly, say for inventory or investments?
Yeah.
Valuation? Do we actually own it? Ownership? And is it shown correctly on the financial statements presentation?
So it's a systematic quality check.
It absolutely is. That rigorous checking is what turns raw data into information people can actually trust.
Okay, now let's bust a myth. If you ask most people outside finance, they think the close starts, day 1 of the new month. BD +1, right? Business day 1 after month end. Common misconception.
But where do the really world-class teams actually kick things off?
Days earlier, days before the month even ends. A truly successful, efficient close absolutely depends on leveraging the pre-close period.
The pre-close.
This is where the leaders gain that huge competitive advantage. And just for clarity, when we say BDX, we mean the Xth business day before the month clicks over.
Got it. BD minus. So walk us through that pre-close timeline. What happens when?
Okay, so picture this. Around BD5, maybe BD3, so 3 to 5 business days before month end, they're already running preliminary numbers.
Already?
Yes. Early analysis, validating key reports. Think high-volume stuff, high-risk areas, like inventory valuations, fixed asset movements, and crucially, clearing up those internal company balances. Intercompany. Getting that reconciled before the month ends must save so much hassle.
Oh, it's huge. If you wait until day 1, BD +1, you're just setting yourself up for a massive time-consuming fire drill trying to figure out who owes what to whom internally.
Right. Okay, so that's BD minus 5 to 3. What about closer to the end?
Then you move into final prep, BD2, so 2 days before. That's often focused on accrual planning, identifying things that happen but aren't invoiced yet, getting those cutoff transactions properly documented.
Makes sense. And BD minus 1.
BD1, the day before month end. That's often the accounts payable, the AP cutoff. making absolutely sure every invoice for that period is either recorded or properly accrued for.
So by the time you actually hit BD0, the last calendar day of the month, what's left?
You're focused almost entirely on the final operational cutoffs, closing the accounts receivable side and doing your formal revenue recognition postings. The big stuff is largely prepped.
So the benefit is really clear. Starting early just changes the game.
It transforms the close. These really well-oiled finance teams, they run rolling validations all month long. So closing day or those first few days after month end, it stops being this frantic scramble of discovery.
Yippee goes.
It becomes a process of calm confirmation, checking things off rather than finding nasty surprises.
I like that framing. Confirmation, not discovery.
Mm-hmm.
Because, yeah, if you're only discovering on day one that your inventory subledger doesn't tie to the general ledger,
Yeah.
well, you're already behind.
You've already failed, effectively.
Which leads us perfectly into the next big idea, this concept of continuous validation as the real secret weapon for speed.
Exactly. The core philosophy here is that these top-tier teams, they sort of never stop closing. They build these checks and validations right into their normal daily and weekly routines.
Go spreading the load.
Precisely. Spreading the work across, say, 20 business days instead of jamming it all into one incredibly high-pressure week.
Okay, give us some concrete examples. What does continuous validation look like in practice?
Well, some things are daily non-negotiables. Daily bank reconciliations, for example.
Every single day.
Every single day, matching all the cash coming in, cash going out, transfers between accounts. You do this daily because if you let cash drift, even for a few days, one small error can just balloon into a massive investigation nightmare.
Okay, daily banks. What else? Maybe weekly.
Weekly, you'll definitely see rigorous subledger reviews. So reconciling your account's payable subsidiary ledger total to the AP control account in the general ledger. Same for accounts receivable, same for inventory, making sure those key operational systems tie out to the main financials.
And I saw mention of mid-month reviews too.
Yes, smart teams do mid-month variance reviews, comparing actual results partway through the month against the latest forecast or the budget.
Why mid-month?
Because if, say, your utilities expense suddenly looks way higher than forecasted halfway through the month, you flag it then. Is it a misclassification?
Yeah.
A posting error? You investigate and fix it mid-month, not wait until the pressure of the close hits.
So the theme is clear. Constant activity smooths out that end-of-period spike. Okay, let's shift gears slightly. To make all this work, you need a solid foundation. Let's talk through what our sources call the 8 pillars of an effective close, starting with structure and people.
Right. Pillar number 1 is clear structure and ownership. You absolutely need a detailed, written down, structured closing calendar.
Not just in someone's head.
Definitely not. It needs to define specific cutoff dates, specific deliverables for every function involved, not just finance, and crucially, assign clear ownership for every single step. Track it visibly, maybe on a shared dashboard. That drives real accountability.
Okay, structure and ownership first, then comes control. Right.
Exactly. Pillar 2. Standardization and control. This means standardizing your journal entry process, using templates for the routine stuff. But the absolute key control point, requiring proper supporting documentation and reviewer sign-off for any manual journal entry. No exceptions.
Why is that so critical?
It massively strengthens your internal control environment, reduces errors, reduces the risk of fraud, and frankly, makes your auditors much happier. It's a quick win for control.
Okay, so people, process, now technology. Pillar 3.
Pillar 3 is intelligent automation, using tech smartly. Automating those recurring, predictable entries, think depreciation, prepaid amortizations, standard monthly accruals. This frees up huge amounts of human time.
But there's a really important warning here, isn't there? The source says automation shifts responsibility. It doesn't remove it.
Precisely. That's such a key takeaway. Automation is fantastic, but it just shifts the accountant's job. Instead of keying in the depreciation journal, their job is now to validate the output of the automated depreciation calculation.
You can't just assume the machine got it right.
Never assume. You still own the accuracy. And validating systems like that requires alignment, which brings us to Pillar 4, centralized checklist and communication.
Right. Confusion kills speed. Who owns this reconciliation? Where did that data come from?
Exactly. That's why having one central, shared, close checklist is vital, covering everything, GL, AP, AR, payroll, intercompany, the lot, and bolstering that with strong communication. Think daily stand-up meetings during close week.
Getting finance, IT, And maybe FP&A, financial planning and analysis, all on the same page.
Absolutely.
Yeah.
Aligned on data cutoffs, system availability, any issues that pop up. Communication prevents roadblocks.
Okay, now Pillar 5 touches on a really modern challenge, especially with big ERP systems. Validation over assumption.
Yes, this is about reconciling the system itself. Modern integrated ERPs are great for speed, data flows automatically. But that integration introduces a kind of dual challenge for accountants.
Explain that dual challenge. What do you mean?
Well, first, you still have to do the basics, reconcile the subledger totals back to the GL control accounts, daily, ideally. But second, you now also have to validate the system's work, the mapping logic between modules, the accuracy of the interfaces feeding data in.
So the integration is only as good as the rules you set.
Exactly. And only as reliable as the accountants who constantly question it and test it. The source put it perfectly. Integration is only as reliable as the accountants who question it. You have to poke the system.
That really does shift the accountant's role, doesn't it? Less recording, more
Yeah,
testing the plumbing.
precisely. Which leads nicely into Pillar 6, focusing effort smartly with exception management.
Okay, what does that mean in practice?
This is where efficient teams really shine. Instead of trying to manually review every single transaction or every single account reconciliation, they use analytics tools.
Like Power BI or specific reconciliation software.
Exactly. Tools like that can automatically flag the big deviations, the unusual journal entries, the outliers based on history or rules.
So you're focusing human eyes on the high-risk exceptions, not drowning in low-value noise.
That's the goal. Apply that critical human judgment where the risk and the value are highest. It focuses limited review time incredibly effectively.
Smart. Okay, and Pillar 7 brings us full circle.
Pillar 7, the substance check. It loops back to our earlier point. The goal isn't just a fast close, it's closing accurately and intelligently. Speed should be the outcome of having great controls and processes, not the overriding priority that compromises quality.
That whole structure, the planning, the continuous checks, the smart use of tech, focusing on exceptions, it really paints a picture of a world-class closing process.
Beyond those technical steps, what's the biggest, maybe cultural difference you see in these top teams?
I'd say it's fostering a no-surprises culture,
Meaning?
meaning issues get raised early. If there's a potential problem reconciling inventory on BD5, it's flagged then. It's not hidden or ignored until the final review day on, say, BD+3 when it becomes a crisis.
That requires trust, doesn't it? Psychological safety for people to speak up.
Absolutely. Transparency and safety are key. And this culture, it gets measured. They don't just track if they hit the close deadline.
What else do they track? They track the quality metrics that come later. Things like the number and size of post-close adjustments needed, the error-free submission rates to corporate or regulators. They measure the quality of the finish, not just the speed to get there.
And all of this points to how the accountant's role itself is changing.
Fundamentally shifted. The focus moves dramatically away from just data entry or basic ticking and tying reconciliations. It's moving towards judgment, validation, and interpretation.
Because automation handles the routine stuff now.
Right. Automation handles the transactions, but only the human accountant, applying professional skepticism and business knowledge, can look at the overall result and say, wait, does this actually make sense? Does this reflect the reality of what happened in the business this month?
So the modern finance pro is more like a risk manager, an analyst.
Exactly. The role is about testing those system integrations we talked about, validating the analytical relationships between different accounts, and critically, explaining what the numbers mean for the business, the story behind the data, not just reporting what the numbers are. It's about proving understanding.
You know, this whole deep dive really hammers home that the month-end close shouldn't be seen as this isolated period of panic. It's really a continuous discipline.
It truly is a combination of having that robust structure, using technology intelligently, and applying that professional skepticism day in, day out.
And those organizations that close fast and accurately, they didn't just stumble into it or work insane hours necessarily.
No, they got there because they planned early, like we discussed with the pre-close. They validate continuously throughout the month. They automate intelligently. And crucially, they instill that sense of ownership for accuracy right from day one.
And the ultimate payoff for getting this right, it's confidence, isn't it?
Absolutely. The goal is to deliver numbers that management, investors, everyone can trust. Numbers that are complete, consistent, reliable. Because really, when your close runs smoothly, the entire company runs with more confidence.
So, a final thought for our listeners to take away.
Yeah, maybe challenge yourself to think. Which one of these continuous validation tactics could you start implementing, even in a small way, starting today? Could you push for daily bank recs, formalize some pre-close checks, start weekly subledger reviews, anything that helps shift your process away from that end-of-month frantic discovery towards calm, planned confirmation?